Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can understand what we see in the global landscape. You know, every other week or so I like to do these update videos for our clients, and occasionally we do send these out to other people that subscribe to our alerts via our website. And it's interesting, I receive a lot of questions, not only if I'm out for dinner. Often people run into me and say, Brian, I've seen you on the TV or I've heard you on your radio show, I've got a question about this or a question about that. You know, we love receiving questions, whether it's one-on-one, whether it's by email, but the most important thing is that your questions always get answered. So of course, if you're not a client of our firm, send us an email question, I'll answer it on my TV or radio show. Of course, if you are a client, call us at any time. We want to make sure your questions are answered, and if you have any concerns about the economy, the markets, your portfolio, so that you're on track. I want to start off a little bit today just about the economy in general. I talked about market corrections throughout this year, and I do all through most years. In fact, I talked about this correction that I felt we'd have a 10% correction sometime this year, simply because we haven't had one in over 3.5 years. Statistically, we have 10% correction almost every year. We haven't had one in 3.5, so we were kind of due. I didn't know it was going to come. Of course, I never like a correction, but I know it's a natural part of the building process. The big key is it's how you react when you do have a market correction. Do you get hysterical? Do you get highly emotional? Do you sell at the bottom and wait for things to get better? That's exactly the wrong thing to do. Fundamentally, you know, I've had a lot of clients ask me, Brian, what do you think about this last market correction? You know, did you raise a lot of cash or do you felt we should have? If we're not seeing changes in fundamentals, which we are not in the U.S. economy, other than things look like they're getting a little bit better, you don't want to make drastic reactions to your portfolio. If, on the other hand, we started to see real signs of a slowing economy, recessionary indicators start to pop up, things that we put together in-house and review, and also outside research that we purchase. If we started seeing definite signs and calls on recession, we would definitely raise significant amounts of cash. So with that said, you're always going to have bumps in the road in a portfolio. It's a natural process. It's what happens over the next 1, 2, or 3 years that really matters to your money. Will things grow in the U.S. economy? I firmly believe so. Are corporate earnings doing pretty good? Yes. I look at the unemployment numbers last week and the claims, they were good. If I look at wages, they're actually getting better, meaning people are actually making more money. Those are positive things for the U.S. economy. Remember, about 70% of our economy is consumer-based or consumer-driven, and that's important. Consumers are spending. Auto sales are doing well. Housing's doing well. Interest rates are low, but I firmly believe, and I know I may sound like a broken record, but I firmly believe that the Fed's going to raise rates sometime this year. It may be in December, but ultimately the economy is doing good. They can take their foot off the gas pedal a little bit and raise rates. In my opinion, if they do raise rates, which I firmly believe they should have in September, it's going to be very slow and methodical. A quarter point here, quarter point there. It might be a quarter point 1 month. They might wait 6 months to raise it another quarter point. So it's going to be kind of a wait and see kind of scenario. But bonds ultimately are not going to do that great. We're already seeing that. We're positioned in a little bit more cash in our more conservative models for our clients. So we've actually taken down our bond exposure. We do own floating rate securities, which actually help protect against rising interest rates to some extent. So we like that. But ultimately, I think the U.S. economy is on track to do well. I don't see the world going into a recession. There's a lot of talks about China slowing down and devaluing their currency. And of course, these are small events that created some of the turbulence you saw about a month ago. I'm glad to say that most of that market correction is gone. Simply gone. This is how corrections happen. They happen often swift, and they often rebound swift. So if you sold at the bottom, now you're basically buying back 10 or 12% higher. Bad mistake. Changing fundamentals are one reason to raise some cash. We didn't see that. We're not seeing deterioration in the U.S. economy. We're seeing continued trends on the upside. Relative strength is important. Relative weakness is also important. We're seeing relative strength in the U.S. economy as we are seeing relative strength in the investment positions that we own in our portfolios. We'll make changes when appropriate, but not just haphazardly, just because we're getting some turbulence in the overall economy or the market on the short term, not deteriorating fundamentals. If you're a client of our firm, please give me a call if you have any questions or to schedule a review. If you're not a client, call my firm for a consultation. It's time you became a client. Make sure you have yourself a safe and profitable day.